interest rates are higher and all of the low-hanging fruit was picked and there was efficiencies created across all those pieces of low-hanging fruit that already got picked, and your point is like, what's left? Is there a correlation there to, geez, maybe that's why we're seeing more of a push to get the public masses into this, because the institutional investors maybe are just too smart to be buying into private equity right now, and they know that. And so the private equity funds are saying, well, geez, let's go raise money from somebody else that may not be tuned into that.
It's certainly a plausible theory. I don't think they'd ever admit it to us or anyone for that matter, because it doesn't sound nice. But yeah, I guess it goes back to why now? Why can we join the party now? All of a sudden, these 22%-ish returns, which is a number that I see floated out there occasionally. We've made all the money that we can or want to, so we'll let everybody else have a taste. I mean, I've never once had somebody in my life come say, I'm making more than 20% a year. Would you like me to show you how so that or you can do it or get in? Usually when people are in those kinds of returns, the funds are closed for the most part, unless you get in very early. So, yeah, look, I mean, wearing the skeptic's hat, it's a big raised eyebrow. Like, why now? And I mean, I think we've sort of explored the idea of, will the returns be the same? I'm skeptical that they will, but time will tell.
Yeah. You mentioned there were a couple reasons for including private equity in portfolios. I know we just talked about the outside returns, but how about some other ones?
Yeah, I mean, I guess it's sort of their selling points as I understand them from reading these transcripts. And another one is that Australia's retirement system is in way better shape than the retirement system in the United States. And I don't really have the data to analyze that personally, so I take their word for it. I assume they've done their homework. But, if you go look at Australia's interest rates, they've followed a very similar path to U.S. interest rates over the past 20 or 30 years. So it kind of goes back to that same question. If there's no declining interest rate tailwind, do the returns come in the future? And because Australia had more allocation to privates historically, they did better historically, but will that sort of go forward into the future? And ultimately, I think I have the same skepticism on that argument, because I think the macro tailwind is gone for the foreseeable future. Now, that said, the stock market keeps going down, so maybe they cut rates and things change. But at the moment, hopefully that doesn't happen.
Right. And how about a third?
Yeah, I guess the third one is that, and it's valid, but it's that the stock market has really become concentrated in sort of the Mag 7 or a handful of stocks. And they say these stocks are incredibly volatile. NVIDIA moves 20% a month, 10% certain days. So we need to start to rethink what's risky and what isn't, because historically, private markets, that's risky. I can't get out. But then you have NVIDIA or Tesla's down almost 50% in 2 months now. So I think the argument essentially goes that public is very risky because it's highly concentrated in highly valued stocks that are moving a lot. Look, the bear case on these high growth stocks has been around for a lot of years. And ultimately, who knows? Will NVIDIA go to 30 or 400 first? I mean, I don't know. These things can keep running for long periods of time. The other big thing is volatility, in my opinion, is not risk. So basically, modern portfolio theory says that you want to look at your return versus your volatility, and you want to get the best portfolio. And volatility is measured by something called a standard deviation. And that's essentially just a measure of how volatile something is. And ultimately, I did an analysis once where I said, okay, let's compare volatilities, aka risk, of different portfolios and see how they add up. And what I found was that a portfolio that's flat this month, up 10, flat, up 10, flat, up 10, continue on, has the same volatility as one that's up 5, down 5, up 5, down 5. And so if you step back and think about that, it's like, wait a minute, you're telling me a portfolio that never loses any money is just as risky as one that makes and loses the same amount every month. And per the math, that's true. Now, to modern portfolio theory's credit, the average return will be higher on the portfolio that doesn't lose money and goes up. But I think that sort of trying to call volatility risk is problematic because, as I just pointed out, something could just keep going up and it's going to be, oh, well, that's really risky. But if it never goes down, is it? So that's essentially the argument, is that the stocks are too volatile and therefore they're too risky. But I think the idea of volatility is risk is a problematic assumption.